FA2 Key Terms Part A. Basic Bookkeeping. Chapter 1. Assets, Liabilities and the Accounting Equation. Profit. Profit is the excess of income over expenditure. When expenditure exceeds income, the business is running at a loss. Assets. An asset is something valuable which a business owns or has the use of. Liability. A liability is something which is owed to somebody else. Business entity concept. A business is always treated as a separate entity from its owners for accounting purposes. This is known as the business entity concept. Capital. Capital is an investment of money, funds, with the intention of earning a return. A business proprietor invests capital with the intention of earning profit. The business owes the capital and the profit to the proprietor. Net assets. Net assets equal total assets less total liabilities. Drawings. Drawings are amounts of money taken out of a business by its owner. Credit transaction. A credit transaction is a sale or a purchase which occurs sometime earlier than cash is received or paid. Account payable. An account payable results from the purchase by a business of items for later payment. An account payable is a liability of the business. Trade account payable. A trade account payable is a balance owing for debts incurred in the course of trading operations. The term might refer to debts still outstanding which arise from the purchase from suppliers of goods for resale. Account receivable. An account receivable results from the sale by a business of items for later payment. An account receivable is an asset, the right to receive payment is owned by the business. Trade account receivable. A trade account receivable is a balance owing to the business for debts incurred in the course of trading operations, i.e. because the business has sold its goods or services. Double entry bookkeeping. Double entry bookkeeping is the system of accounting which reflects the fact that every financial transaction affects the entity in two ways and gives rise to two accounting entries, one a debit and the other a credit. The total value of debit entries is therefore always equal at any time to the total value of credit entries. Chapter 2. Statement of Financial Position and Income Statement. Statement of Financial Position. A statement of financial position is a statement of the assets, liabilities and capital of a business at a given moment in time. It is drawn up, as at a particular date. Typically, the statement is prepared to show the assets, liabilities and capital as at the end of the accounting period to which the financial statements relate. Non-current assets. A non-current asset is an asset acquired for use within the business, rather than for selling to a customer, with a view to earning income or making profits from its use, either directly or indirectly, over more than one accounting period. Current assets. Current assets are items owned by the business with the intention of turning them into cash within 1 year, inventories of goods, and account receivables. Cash, including money in the bank, owned by the business. Assets are current in the sense they are continually flowing through the business. Current liabilities. Current liabilities are accounts payable of the business that must be paid within a fairly short period of time, by convention, within 1 year. Non-current liabilities. Non-current liabilities are debts which are not payable within the short term, and so any liability which is not current must be classified non-current. Just as current by convention means 1 year or less, non-current means more than 1 year. Income statement. The income statement matches the revenue earned in a period with the costs incurred in it. It is usually to distinguish between a gross profit, sales revenue less the cost of goods sold, and a net profit, being the gross profit less the expenses of selling, distribution, administration, etc. If costs exceed revenue, the business has made a loss. Income statement. The income statement shows both the gross profit and the net profit for the accounting period. Gross profit is the difference between the value of sales and the purchase costs or production cost of the goods sold. Net profit is the difference between gross profit and the total of the overhead expenses incurred in running the business. Capital expenditure. Capital expenditure is expenditure which results in the acquisition of non-current assets, or an improvement in their earning capacity. Capital expenditure on non-current assets results in the appearance of a non-current asset in the statement of financial position of the business. Capital expenditure is not charged as an expense in the income statement. The cost of a non-current asset includes its purchase price as well as what are called directly attributable costs such as initial delivery costs, installation costs and professional fees, for example, for architects and engineers. Revenue expenditure. Revenue expenditure is expenditure which is incurred, for the purpose of the trade of the business, including expenditure classified as selling and distribution expenses, administration expenses and finance charges. To maintain the existing earning capacity of non-current assets, for example repairs to non-current assets. Revenue expenditure is shown in the income statement of a period, provided that it relates to the trading activity and sales of that particular period. If it carries over into the next period, revenue expenditure would appear as a current asset in the statement of financial position. Capital income. Capital income is the proceeds from the sale of non-trading assets, i.e. proceeds from the sale of non-current assets. The profits, or losses, from the sale of non-current assets are included in the income statement of a business, for the accounting period in which the sale takes place. Revenue income. Revenue income is income derived from the sale of trading assets, such as goods bought or made for resale. Rent, interest and dividends received from non-current assets held by the business. Revenue income appears in the income statement. Chapter 3. Recording and summarizing transactions. Source documents. Source documents are the source of all the information recorded by a business. Invoice. An invoice is a demand for payment. Credit note. A credit note is used by a seller to cancel part or all of a previously issued invoice or invoices. Books of prime entry. Books of prime entry form the record of all the documented transactions sent and received by the company. Cash received day book. Most businesses maintain separate receipts and payments day books for cash. The cash received day book and check issued day book are books of prime entry and are used to keep a cumulative record of money received and money paid out by the business via its bank account. Petty cash book. The petty cash book is the book of prime entry which keeps a cumulative record of the small amount of cash received into and paid out of the cash float. General ledger. The general ledger is the accounting record which summarizes the financial affairs of a business. It contains details of assets, liabilities and capital, income and expenditure and profit and loss. It consists of a large number of different ledger accounts, each account having its own purpose or name and an identity or code. Another name for the general ledger is the nominal ledger. Posting. Posting means to enter transactions in ledger accounts in the general ledger from books of prime entry. Often this is done in total, i.e. all sales invoices in the sales day book for a day are added up and the total is posted to the receivables ledger control account, but individual transactions are also posted, for example non-current assets. Trade discount. A trade discount is a reduction in the price of goods below the amount at which those goods would normally be sold to other customers of the supplier. Trade discount. A trade discount is a reduction in the amount of money demanded from a customer. Cash discount. A cash discount is an optional reduction in the amount of money payable by a customer. Chapter 4. Posting transactions, balancing accounts and the trial balance. Personal accounts. Personal accounts include details of transactions which have already been summarized in ledger accounts, e.g. sales invoices are recorded in sales and receivables, payments to payables in the cash and payables accounts. The personal accounts do not therefore form part of the double entry system, as otherwise transactions would be recorded twice over, i.e. 2 debits and 2 credits for each transaction. They are memorandum accounts only. Receivables ledger. The receivables ledger consists of a number of personal customer accounts. They separate accounts for each individual customer, and they enable a business to keep a continuous record of how much a customer owes the business at any time. The receivables ledger is often also known as the debtors ledger or sale ledger. Payables ledger. The payables ledger, like the receivables ledger, consists of a number of personal supplier accounts. These are separate accounts for each individual supplier, and they enable a business to keep a continuous record of how much it owes each supplier at any time. The payables ledger is often known as the bought ledger, creditor's ledger or purchase ledger. Control account. A control account is an account in the general ledger in which a record is kept of the total value of a number of similar but individual items. Control accounts are used chiefly for receivables and payables. They should agree with the total of the individual balances and act as a check to ensure that all transactions have been recorded correctly in the individual ledger accounts. Receivables ledger control account. The receivables ledger control account, also known as the receivables account, is a control account in which records are kept of transactions involving all customers in total. It is posted with totals from the sales day book and cash receipts day book. The balance on the receivables ledger control account at any time will be the total amount due to the business at that time from its customers, and will agree with the total of the receivables ledger accounts. The payables ledger control account. The payables ledger control account, also known as the payables account, is an account in which records are kept of transactions involving all suppliers in total, being posted with totals from the purchase day book and checks issued day book. The balance on the payables account at any time will be the total amount owed by the business at that time to its suppliers, and will agree with the total of the payables ledger accounts. Sales tax. Sales tax is a tax levied on the sale of goods and services. Most of the work of collecting the tax falls on businesses, which hand the tax they collect over to the tax authorities. Sales tax is also known as VAT. Output tax. Output tax is sales tax charged on goods and services sold by a business, that is, the business output. Input tax. Input tax is sales paid on goods and services bought in by a business. The journal. The journal keeps a record of unusual movement between accounts. It is used to record any double entries made which do not arise from the other books of prime entry. Journal voucher. A journal voucher is used to record the equivalent of one entry in the journal. Trial balance. A trial balance is a list of ledger account balances shown in debit and credit columns. It is sometimes known as the list of balances and it is used as a basis for preparing the final accounts. Its purpose is to highlight certain errors that may have occurred in the double-entry accounting system. Batch processing. Batch processing is where similar transactions are gathered into batches, and then each batch is sorted and processed by the computer. Control totals. Control totals are used to make sure that there have been no errors when the batch is inputted. A control total is used to make sure that the total value of transactions inputted is the same as that previously calculated.